My friends, we gather here today not as victims of circumstance, but as architects of destiny. You are not here by accident. You are here because something deep within your soul refuses to accept mediocrity. You are here because you understand that the difference between the wealthy and the poor, between success and failure, between mastery and mediocrity, lies not in luck or circumstance, but in the fortress of your own mind. I want you to understand something fundamental about the world we live in. Every single day, millions of people make financial decisions that will either elevate them or destroy them. They buy stocks they know nothing about. They invest in businesses they have never researched. They follow the crowd like sheep walking toward a cliff. They allow emotion to govern their judgment, and then they wonder why their bank accounts remain empty while others grow rich. But not you. Not anymore. Today, we build together the most powerful weapon in your arsenal for financial success, the discipline of accurate thinking. This is not mere wishful thinking or positive mental attitude run wild. This is the cold, calculated, systematic approach to processing information that separates the wealthy from the poor, the wise from the foolish, the masters from the slaves. Let me paint you a picture of mental weakness, and I want you to see if you recognize yourself or anyone you know in this portrait. The mentally weak person wakes up each morning and immediately reaches for their phone to check the stock market, their heart racing with anxiety. They see red numbers and panic. They see green numbers and get greedy. They make decisions based on fear when the market drops and decisions based on greed when it rises. This person reads a headline about a hot new cryptocurrency and immediately empties their savings account to buy in at the peak. They listen to their brother-in-law's stock tip at a barbecue and treat it as gospel truth. They watch a financial guru on television and follow every word without question. They are like leaves blown by every wind of opinion, never developing the mental muscle to think for themselves. The mentally weak person is a slave to other people's thoughts. They have abdicated the throne of their own mind and handed the crown to anyone with a loud voice and a confident opinion. They mistake activity for achievement, confusing the noise of constant trading with the quiet discipline of strategic investment. But you are different. You must be different, because the price of mental weakness in the financial arena is not just embarrassment or temporary setback. The price is your freedom. The price is your future. The price is the dreams you will never achieve and the life you will never live. What is accurate thinking? It is the ability to separate fact from fiction, truth from opinion, evidence from emotion. It is the mental discipline that allows you to see reality as it is, not as you wish it were or fear it might be. Accurate thinking is your shield against the manipulation of crowds, your armor against the hysteria of markets, your weapon against the predators who profit from your confusion. Accurate thinking begins with a simple but profound recognition. Most of what you hear about money and investing is wrong. Most of the financial advice floating through the airwaves is designed not to make you wealthy, but to make someone else wealthy at your expense. Most of the urgent buy signals and panic sell recommendations are created by people who profit from your activity, not your success. The accurate thinker understands that in the realm of finance, silence is often more profitable than action. While others are buying and selling in frenzied panic, the accurate thinker sits quietly, observes, analyzes, and waits for opportunity to present itself clearly and unmistakably. Think of accurate thinking as building a fortress around your mind. This fortress has thick walls that protect you from the artillery of mass hysteria. It has high towers that give you a clear view of the battlefield, while others stumble blindly through the fog of confusion. It has strong gates that allow only verified truth to enter, while keeping out the armies of deception that march daily toward your consciousness. Your enemies in this battle for financial mastery are not external. They live within your own mind, and they are more dangerous than any external threat because they wear the mask of your own thoughts. Let me introduce you to these enemies so you can recognize them when they attack. Enemy number one, emotional decision-making. This enemy whispers to you when stocks are falling, telling you to sell everything before you lose more. This enemy screams at you when markets are rising, demanding that you buy now before you miss out. This enemy makes you feel like every decision is urgent, every opportunity is fleeting, every moment of inaction is a moment of loss. But I tell you this, the market does not care about your emotions. The market does not care about your fear or your greed. The market rewards those who can remain calm in chaos and patient in pandemonium. When everyone else is driven by emotion, your emotional detachment becomes your competitive advantage. Enemy number two, the need for immediate gratification. This enemy tells you that you must see results now, that waiting is for losers, that patience is a luxury you cannot afford. This enemy drives you to day trading when you should be decade thinking. It pushes you toward get-rich, quick schemes when you should be building get-rich, certain systems. The wealthy understand something, that the poor never learn time is the greatest multiplier of wealth. The compound interest that builds wealth works slowly and quietly like roots growing deep beneath the soil. You cannot see it working day by day, but over years and decades, it creates forests of financial abundance. Enemy number three, the opinion of others. This enemy is perhaps the most insidious because it disguises itself as helpful advice. Your friends, your family, your colleagues, even financial experts on television, they all have opinions about what you should do with your money. But here's what you must understand. Their opinions are based on their limitations, not your possibilities. When you make financial decisions based on other people's opinions, you are essentially betting your future on their understanding of markets, economics, and investment strategy. You are trusting your financial destiny to people who may never have created significant wealth themselves. Let me tell you about a man named Warren Buffett, not because his strategies are the only path to wealth, but because his approach to research demonstrates the power of accurate thinking in action. Before Buffett invests a single dollar in any company, he studies that company like a scientist studies a specimen under a microscope. He reads every annual report, not just the highlights, but every footnote. He analyzes the company's competitors, their market position, their management team, their debt structure, their revenue streams. He looks at 10 years of financial data, not just last quarter's results. He studies the industry trends, the regulatory environment, the economic factors that could affect the business. Most importantly, he never invests in anything he does not fully understand. While others chase the latest hot stock or trendy investment vehicle, Buffett sticks to businesses whose operations he can comprehend completely. This is not limitation. This is wisdom. This is not playing it safe. This is playing it smart. Your research fortress must be built on the same foundation. Before you invest in any stock, bond, real estate, or business opportunity, you must become an expert on that investment, not an expert compared to your neighbors or your coworkers, but an expert by objective standards. Here is your research protocol, and I want you to write this down because this system will save you more money than any tip or trick you will ever learn. Question 1, do I completely understand how this investment makes money? If you cannot explain in simple terms exactly how your investment generates returns, you are not investing, you are gambling. Question 2, what are the 3 biggest risks that could cause this investment to fail? If you cannot identify at least 3 specific risks and explain how likely each one is to occur, you do not understand the investment well enough to risk your money. Question 3, what evidence do I have that this investment will perform as expected? Hopes and dreams are not evidence. Marketing materials are not evidence. Testimonials from satisfied customers are not evidence. Only verifiable, objective data constitutes evidence. Question 4, am I investing because of my own analysis or because someone else told me to? If your decision is based on someone else's recommendation, you are not thinking accurately, you are thinking dependently. In a world where everyone has an opinion about your money, strategic silence becomes your superpower. While others are broadcasting their every financial move on social media, seeking validation for their decisions, you operate in quiet confidence. While others are asking for advice from anyone who will listen, you trust your own research and analysis. Strategic silence means you do not discuss your investment strategy with people who have not achieved the financial success you desire. Think about this carefully. Why would you seek financial advice from someone who struggles with money? Why would you share your wealth, building plans with people who have never built wealth? This does not mean you become arrogant or secretive. It means you become selective. You understand that most people's financial opinions are based on their fears, their limitations, and their lack of knowledge. Their well-meaning advice could derail your carefully planned strategy. Let me share with you a story that illustrates the power of strategic silence. In 1943, during World War II, a young man named Jack Bogle developed an investment thesis that would later revolutionize the mutual fund industry. His idea was simple. Instead of trying to beat the market through active trading, why not create a fund that simply matched the market's performance at the lowest possible cost? When Bogle shared this idea with his professors, his colleagues, and industry experts, they told him it was impossible, impractical, and would never work. The existing financial industry had no interest in a low-cost solution because high fees were their primary profit source. If Bogle had listened to the opinions of others, the Vanguard Group would never have been created, and millions of investors would never have benefited from low-cost index fund investing. But Bogle practiced strategic silence. He stopped seeking validation from others and focused on proving his thesis through research and eventual implementation. Today, Vanguard manages trillions of dollars and has saved investors hundreds of billions in fees. Your silence is not weakness, it is strength. Your refusal to seek constant validation is not antisocial behavior, it is financial wisdom. When you stop explaining your financial decisions to people who cannot understand them, you stop second guessing yourself based on their confusion. Here is a truth that will either make you wealthy or keep you poor, depending on how well you understand it. The stock market is not a popularity contest. It is a mathematics contest. The market does not care about your feelings, your hopes, your fears, or your need for excitement. The market operates according to mathematical principles that reward discipline and punish emotion. Let me show you the mathematics of emotional detachment with a simple example. Suppose you invest $10,000 in a diversified portfolio of stocks. In year one, the market drops 20%, and your portfolio is now worth $8,000. The emotional investor panics and sells, locking in a $2,000 loss. But the emotionally detached investor understands that market fluctuations are temporary, while business growth is permanent. Instead of selling, they continue their investment plan. In year two, the market recovers and grows 15%. Their $8,000 portfolio becomes $9,200. In year three, another 12% growth brings them to $10,304. After 3 years, the emotional investor has lost $2,000 and earned nothing on the money they removed from the market. The emotionally detached investor has gained $304 plus the compounding effect of continued investment during the recovery period. This is not theory. This is mathematical reality. Emotional decisions in investing are almost always wrong because they are made at the wrong time for the wrong reasons. Fear makes you sell when prices are low. Greed makes you buy when prices are high. This is the exact opposite of profitable behavior. The emotionally detached investor operates like a machine program for success. When others are selling in panic, they are buying at discounted prices. When others are buying in greed-driven frenzy, they are either holding their positions or taking profits. They understand that their emotions are not market signals, they are market noise. I want you to make a declaration today, not to me, not to this audience, but to yourself. I want you to declare your independence from the financial opinion of others. I want you to declare your independence from the need to follow the crowd. I want you to declare your independence from the emotional roller coaster that destroys most investors' wealth. This declaration is not made with words. It is made with actions. Your independence is not something you announce. It is something you demonstrate through your behavior day after day, decision after decision, investment after investment. Financial independence begins with mental independence. When you stop looking to others for validation of your financial decisions, you stop making decisions designed to impress others rather than enrich yourself. When you stop following the latest investment fads, you start building investment systems that compound wealth over time. Here is what your independence looks like in practical terms. You no longer check your investment accounts daily because you understand that daily fluctuations are meaningless noise in the symphony of long-term wealth building. You check your accounts quarterly or annually, focusing on trends rather than temporary movements. You no longer make investment decisions based on news headlines because you understand that news is designed to create emotional reactions, not informed decisions. You make decisions based on your research, your analysis, and your long-term strategy. You no longer distrust your investment returns and family because you understand that your wealth is not a performance to be evaluated by others. Your wealth is a private matter between you and your financial goals. You no longer feel the need to justify your investment choices to people who question your approach because you understand that their questions reflect their confusion, not your mistakes. Now we move from philosophy to practice. Understanding accurate thinking is valuable, but applying accurate thinking is profitable. Let me show you how to build a practical system that implements these principles in your daily financial life. Step 1, create your information diet. Just as you are careful about what you put in your body, you must be careful about what you put in your mind. The average person consumes dozens of financial opinions every day through news websites, social media, television, and casual conversations. Most of this information is contradictory, biased, or completely wrong. Your information diet should consist primarily of primary sources: company annual reports, economic data, industry analysis, and the writings of investors who have achieved the level of success you desire. Eliminate secondary sources, news commentary, social media investment advice, and television financial programs that are designed to entertain rather than educate. Step 2, establish your research requirements. Before you invest in anything, you must complete a standardized research process. This is not negotiable. This is not something you do when you feel like it or when you have time. This is your minimum standard for every investment decision. Your research file for any investment should include the company's financial statements for the past 5 years, an analysis of their competitive position, an evaluation of their management team, a study of industry trends affecting their business, and a clear explanation of why you believe this investment will be profitable. Step 3, create your emotional circuit breakers. Just as electrical systems have circuit breakers to prevent damage from power surges, your investment system needs circuit breakers to prevent damage from emotional surges. Your emotional circuit breakers are predetermined rules that remove emotion from your decision-making process. For example, you will not make any investment decision on the same day you first learn about an opportunity. You will not buy or sell any investment based solely on that day's news. You will not discuss major investment decisions with anyone until after you have made them based on your own analysis. Step 4, implement your review system. Your investments must be reviewed regularly, but not obsessively. I recommend quarterly reviews for most investments, annual reviews for long-term holdings. During these reviews, you evaluate whether your original investment thesis remains valid, whether any fundamental changes have occurred that affect your projections, and whether any adjustments to your position are warranted. Here is the most important section of our discussion today, because this is where accurate thinking transforms from interesting philosophy into life-changing mathematics. The principle of compounding is the closest thing to magic that exists in the financial world. But it only works for those who understand it and apply it with religious discipline. Albert Einstein allegedly called compound interest the eighth wonder of the world, saying that those who understand it earn it, and those who do not pay it. Whether Einstein actually said this is debatable, but the truth of the statement is undeniable. Let me show you the magic and the requirements of compounding with a story that will change how you think about time and money forever. Two friends, Sarah and Michael, both start their careers at age 25. Sarah decides to invest $200 per month in a diversified portfolio of stocks that averages 10% annual returns. She does this for 10 years, from age 25 to 35, then stops contributing, but leaves the money invested. Michael decides to enjoy his 20s and starts investing at age 35. He invests $200 per month in the same type of portfolio with the same returns. He continues investing from age 35 until retirement at age 65, 30 years of contributions compared to Sarah's 10 years. At age 65, Sarah has contributed $24,000 over 10 years. Michael has contributed $72,000 over 30 years. Michael has contributed 3 times as much money as Sarah. But here is where compounding performs its magic. Sarah's account, which had 30 years to compound after she stopped contributing, is worth over $500,000. Michael's account, despite his much larger contributions, is worth less than $400,000. Sarah contributed less money for fewer years, but earned more wealth because she understood the power of time in the compounding equation. Michael worked harder, saved more, and contributed longer, but he could not overcome the mathematical advantage that Sarah gained by starting earlier. This is not theory. This is mathematical reality. The most important investment decision you will ever make is not what to buy, it is when to start. Every day you delay beginning your wealth building process is a day you cannot recover. Every month you postpone systematic investing is a month of compounding you forfeit forever. But compounding requires accurate thinking to work effectively. You must choose investments that can compound over long periods. You must resist the temptation to interrupt the compounding process by constantly buying and selling. You must understand that compounding works slowly at first, almost invisibly, then accelerates dramatically in later years. We have built your fortress of accurate thinking. We have created your systems for research and analysis. We have established your emotional circuit breakers and your independence from others' opinions. Now we must discuss your strategic offense, because wealth is not built purely through defense. Your strategic offense consists of your ability to recognize and act upon opportunities that others miss or misunderstand, while others are paralyzed by analysis or driven by emotion. You move with calculated precision when true opportunities present themselves. Opportunities appear during periods of maximum pessimism and disappear during periods of maximum optimism. This is not a platitude. This is a mathematical reality of market behavior. When everyone is afraid, prices fall below the actual value of assets. When everyone is optimistic, prices rise above the actual value of assets. Your ability to act contrary to crowd emotion is your primary source of superior returns. But contrarian investing requires more than just doing the opposite of what everyone else is doing. It requires accurate thinking to distinguish between temporary pessimism about fundamentally sound investments and justified pessimism about fundamentally flawed investments. During the financial crisis of 2008, many high-quality companies saw their stock prices fall by 50% or more, not because their businesses had deteriorated by 50%, but because fear had driven investors to sell regardless of fundamental value. The accurate thinker could distinguish between companies facing temporary difficulties and companies facing permanent destruction. Those who had built their fortress of accurate thinking and maintained their emotional detachment were able to purchase shares of excellent companies at deeply discounted prices. Those purchases, made when everyone else was selling in panic, generated enormous returns as markets recovered and businesses resumed their growth. Your strategic offense requires patience, preparation, and courage. Patience to wait for true opportunities rather than chasing false opportunities. Preparation to act quickly when opportunities arise. Courage to act when everyone else is paralyzed by fear or blinded by greed. What gets measured gets managed, and what gets managed gets improved. Your wealth building process must include precise measurements that tell you whether your system is working and where improvements are needed. But most people measure the wrong things and draw the wrong conclusions from their measurements. They focus on daily account balances instead of long-term trends. They compare their returns to other people's returns instead of their own financial goals. They measure activity instead of progress. Your primary measurement is not how much money you made last month or last year. Your primary measurement is whether you are on track to achieve your long-term financial objective. If your goal is to accumulate $1 million by age 50, the only measurement that matters is whether your current wealth and savings rate will mathematically achieve that goal. Secondary measurements include the percentage of your income you are saving and investing, the diversification of your investment portfolio, the cost and tax efficiency of your investments, and the consistency of your investment behavior regardless of market conditions. These measurements must be reviewed regularly but not obsessively. Monthly measurements of savings rate and investment behavior, quarterly measurements of portfolio performance and diversification, annual measurements of progress toward long-term goals. The purpose of measurement is not to create anxiety or to feed your ego when returns are high. The purpose of measurement is to ensure that your system is working and to identify areas where adjustments might improve your results. Your fortress of accurate thinking will be tested. Economic recessions will challenge your resolve. Market crashes will test your emotional detachment. Friends and family will question your strategy during periods of temporary underperformance. Media headlines will scream that everything has changed and your approach is no longer valid. These attacks are not weaknesses in your system. They are proofs of your system's strength. If your approach never faced criticism or doubt, it would mean you were following the crowd, and following the crowd does not create exceptional wealth. During these sieges, you must remember why you built your fortress in the first place. You built it not to avoid all risks, but to take intelligent risks while avoiding stupid risks. You built it not to guarantee that you would never lose money, but to ensure that your losses would be temporary while your gains would be permanent. History provides us with perfect examples of fortresses under siege. During the Great Depression, when unemployment reached 25% and the stock market fell nearly 90% from its peak, those who maintained their investment discipline and continued buying high-quality assets at depressed prices positioned themselves for enormous wealth creation during the recovery. During the technology crash of 2000-2002, when the NASDAQ fell nearly 80%, those who could distinguish between profitable companies temporarily out of favor and unprofitable companies with unsustainable business models were able to purchase shares of future giants at bargain prices. During the financial crisis of 2008-2009, when credit markets froze and real estate values plummeted, those who had maintained cash reserves and emotional discipline were able to acquire assets that would generate decades of wealth. The siege is not your enemy. The siege is your opportunity. While others are abandoning their positions and selling their assets in panic, you are strengthening your positions and acquiring additional assets at discount prices. Victory in wealth building is not measured by a single large gain or a single year of exceptional returns. Victory is measured by the systematic, consistent compound growth of your net worth over decades, victory is the mathematical certainty that your wealth will continue growing regardless of temporary market fluctuations. But victory requires more than just accumulating money. Victory requires maintaining your principles and your system even after you have achieved financial success. The discipline that creates wealth is the same discipline that preserves and grows wealth over generations. I have observed thousands of people who built significant wealth through accurate thinking and systematic investing, only to lose much of it because they abandoned the principles that created their success. They began taking greater risk because they felt invincible. They started listening to other people's advice because they felt their own knowledge was outdated. They became emotional about their investments because they had more to lose. Your victory protocol must include safeguards against success-induced carelessness. As your wealth grows, your commitment to accurate thinking must grow stronger, not weaker. As your investment accounts grow larger, your research requirements must become more rigorous, not more relaxed. As you achieve financial independence, your emotional detachment must become more complete, not less disciplined. Victory also requires that you use your wealth to create more wealth, not just to consume more goods and services. The difference between temporary wealth and permanent wealth is understanding that money is a tool for creating more money, not just a means for buying more things. Those who achieve lasting wealth understand that their lifestyle should grow more slowly than their wealth. If your wealth doubles, your lifestyle might increase by 20 or 30%, allowing the majority of your increased wealth to compound and create even more wealth. The ultimate victory is not just building wealth for yourself, but creating systems and principles that will continue building wealth long after you are gone. This is the difference between creating wealth and creating legacy wealth that benefits multiple generations. Legacy wealth is built on the same principles as personal wealth, but it requires additional thinking about tax efficiency, estate planning, and wealth transfer. It requires teaching the principles of accurate thinking to those who will inherit your wealth, because wealth without wisdom disappears within a generation or two. The families that maintain wealth across multiple generations are not necessarily the families that start with the most money. They are the families that maintain the strongest commitment to the principles of accurate thinking, systematic investing, and emotional discipline. Building legacy wealth requires that you think beyond your own lifetime. Your investment decisions should consider not just your financial needs, but the financial needs of your children and grandchildren. Your business decisions should create assets that can generate in income for decades, not just profits for next quarter. This does not mean that you should sacrifice your financial security for future generations. It means that you should build your wealth in ways that naturally extend beyond your lifetime while providing for your current needs. Legacy wealth is also about more than money. It is about passing on the principles, the discipline, and the accurate thinking that created the wealth. Money without these principles disappears quickly. These principles without money can create wealth in any generation. We have spent our time together building the fortress of accurate thinking that will protect and grow your wealth throughout your lifetime. But knowledge without action is worthless. Understanding without implementation creates no results. You cannot think your way to wealth. You must think your way to the right actions and then take those actions consistently for years and decades. Your first action must be taken today, not tomorrow, not next week, not when you have more money or more time. Today. Because every day you delay beginning your systematic wealth building process is a day of compounding you lose forever. If you have not yet started investing, your first action is to open an investment account and make your first investment, even if it is only $50. The amount is not important. The beginning is everything. If you are already investing, but not systematically, your first action is to establish an automatic investment plan that removes emotion and procrastination from your wealth building process. If you are investing systematically, but not strategically, your first action is to complete the research process we discussed and ensure that you fully understand every investment in your portfolio. If you are investing both systematically and strategically, but not independently, your first action is to stop discussing your investment decisions with people who have not achieved the level of financial success you desire. The fortress of accurate thinking is not built in a day, but it must be started today. Every principle we have discussed, every system we have outlined, every discipline we have examined must be implemented consistently over time to create the wealth you desire and deserve. You now possess the knowledge that separates the wealthy from the poor, the successful from the struggling, the masters from the slaves. But knowledge alone changes nothing. Only action based on knowledge creates results. Some of you will leave here today and implement these principles immediately and consistently. You will build your fortress of accurate thinking, establish your systems for research and analysis, maintain your emotional detachment, and execute your wealth building plan regardless of market conditions or other people's opinions. You will create significant wealth over the coming years and decades. Others will leave here today with good intentions but weak implementation. You will start strong, but allow emotion, opinion, and circumstance to erode your discipline. You will achieve some results, but not the results you could have achieved with stronger commitment to these principles. A few will leave here today and change nothing. You will continue making the same financial mistakes, following the same emotional patterns, seeking the same validation from others. You will continue getting the same financial results you have always gotten. The choice is yours, and the choice is now. Your financial future will be determined not by market conditions, economic circumstances, or investment opportunities, but by the consistency with which you apply the principles of accurate thinking to every financial decision you make. The fortress is designed The plans are drawn. The materials are available. But only you can build your fortress. Only you can maintain your discipline. Only you can create your wealth. Begin today. Begin now. Begin with whatever resources you have available. But begin because your future self is depending on the actions you take today. The fortress of accurate thinking awaits your construction. Your wealth awaits your discipline. Your financial freedom awaits your commitment. Build your fortress. Master your mind. Create your wealth. The time for thinking is over. The time for action has begun.